Welcome back. Today we're going to talk about the Fed Financial Stress Index. It's a tool that's used by the Federal Reserve to measure the level of financial stress in the markets. It's comprised of a series of data sets maintained by the Federal Reserve. It includes a number of calculations based on interest rates and yield spreads. A zero level indicates normal market conditions. When the stress index is above zero, it indicates an above average level of stress. When it's below zero, a below average level of stress. We compare the Fed stress index to the federal funds rate, interest rates, which are shown in red, the Fed stress index in blue. And we can see going back to 2017, 2018, when the markets were very strong, and we can see interest rates are rising over time. The Fed stress index level was in negative territory, which makes perfect sense because when we have strong market conditions, a healthy bond market where the longer term maturities have a higher yield than the shorter term maturities, we see the Fed stress index is low. When we come up to the stock market crash early 2020, interest rates were slashed very quickly, and the Fed stress index level skyrocketed to a little over 5. Well, markets resumed their upward trend as interest rates were maintained very close to low for quite a long time. And then eventually, interest rates started to rise. The Fed stress index level remained low. However, until a point, we see that it started to get kind of choppy over here. This in part was due to the distortion in the bond market, which we're going to take a closer look at. Here we see the Fed stress index level in blue, yellow S&P 500. Again, starting after the COVID crash in early 2020, stock market was very strong. Fed index stress index level is very low. However, when the stock market started to move to the downside, in part due to inflation, in part due to very quickly rising interest rates, we started to see a distortion in the bond market, and we started to see this choppy Fed stress index. Taking a closer look at exactly what this looked like, the yellow is the S&P 500 again. We look at early 2023, just over the past couple of months, the Fed stress index level was at low, below zero, at actually pretty significant lows. However, we did see a spike higher up to the 1.58 level due in part to the real distorted condition of the inverted bond markets. Taking a look also back to May, June of last year, that's when the bond market first inverted. And that's when we started to see this choppy Fed stress index level. We see the blue histogram bars start to pop up. Now, we compare the Fed stress index level again in blue. The green line is a 10-year U.S. Treasury. The red line is a 1-year U.S. Treasury. We saw the inversion begin around June, July of 2022. That's when the red line crossed above the green line. That's the beginning of the inversion. Now we can see most recently, this pop-up in the Fed stress index level coincides with a real big reduction in yield. It's not only that we have an inverted bond market, it's that we start to see a real collapse in the yields. Now, take a look at the orange area chart. That's the 10-1 U.S. Treasury spread, the difference between a 10-year bond and the 1-year bond. The blue is the Fed stress index. Now, going back to 2014, we saw there was a much higher yield for the 10-year than there was for the 1-year. And that's shown over here as the red area chart is so high on the left-hand side. But we can see as this declines, it's showing us that the 10-year is starting to lose ground against the 1-year. And eventually, June, July of last year, turning negative. This negative is the beginning of the inverted bond market. But notice what occurred over time. We see all of a sudden a big drop around April of 2016 in the 10-1 spread. That coincides with the Fed stress index. The Fed stress index really does show us a very clean representation of what's happening in the bond market, the health of the bond markets. Now we compare the statistics. This shows us the past 30 days performance in the S&P 500 per level of stress index. So, for example, right now we have currently a negative 0.3 Fed stress index level, which indicates over the past 30 days, statistically speaking, the S&P 500 has gone up around 1%. If we were to see a -1 on the Fed stress index level, that indicates the S&P probably went up around 2%. But notice what happens when the Fed stress index level turns positive on the x-axis. That indicates, right, that correlates with negative stock market performance. In other words, we take this extreme level. When we saw, statistically speaking, a Fed stress index level of 0.7 to the upside, that correlates with a 9% drop within 30 days, 30 calendar days, 20 trading days for the S&P 500. So point being, this can really be used as a gauge to look for confirmation to see how extreme the markets have acted lately. And we can also look for perhaps reversals after big market moves. So currently, again, we're at a -3 on the Fed stress index level. That indicates a somewhat neutral market condition, slightly to the positive side. However, it's going to be very interesting to see what this looks like after a big market move. Perhaps it'll help us find a pivot point in our next big trend. We hope this has been helpful. We look forward to seeing you back soon.